Hi, Ben Kingsley here, and I've got another great episode here talking property tax with Julia Hartman. So thrilled that you can spend some time with us in terms of learning more about all things tax. So I want to introduce you to this episode, and also in terms of what we do here. Talking property tax is an educational tax series which is led by Julia Hartman, who is one of Australia's leading tax experts when it comes to all things property investing and all things personal tax matters. Now, Julie is the founder of the Land Tax Co-op Group, of which Empower Wealth Tax and Personal Accounting is a co-op member. Julia is also the Chief Technical Tax Advisor here at Empower Wealth. So welcome to episode 3, Julia.
Thank you for having me, Ben.
No worries. Now, before we kick off today's discussions, I wanted to take this opportunity for those who are new to these episodes and to learn more about some of the past episodes we've discussed. So I'll just do a quick review of some of the episodes that we've covered off. In episode 1, we covered off on the top 5 tax rules every property investor must understand. And so we went through negative gearing, turning your PPR OR into a property investment, the 6-year rule, renting out your principal place of residence or holiday home in an income producing property capacity, and then the big tax change, rate change that was happening in 2024. So that's episode 1 if you want to check that out. Episode 2, we broke up into 2 parts. We did the tax planning to tips for minimizing your tax returns. So in episode 2, part 1, we talked about how much you make of your super contribution and how can you do that. We did best practice in terms of personal tax bookkeeping, especially working from home, discussions that we had in there. And then the end of year considerations for property investors was part 1 of episode 2. In terms of part 2 of episode 2, we also continued on in terms of tax tips to minimize your tax return. And that was claiming car tax travel expenses. And then we also talked about other travel expenses in terms of inspecting your investment properties, and the rule changes there for those who weren't aware. And then we worked through some of the depreciation claims as well in terms of the why, when, and how. So if you want to check out those past 2 episodes, you can find them on our YouTube channel. And also the audio recording of those have been made available on the Property Couch podcast as well. Now, in this episode, we're going to continue our theme in terms of talking about cars as we'd promised. So we're going to look at salary sacrificing for cars. Then we're going to have a little bit of an interesting look at electric vehicles under the new federal Labor government in terms of what they're doing there. And so that will round out our discussions when it comes to cars and what we can claim and what we can't claim. And then we're going to talk about private health insurance. Is it worth it? And finally, we're going to have a look at the Queensland Land Tax Changes, and in terms of what does that mean from technical point of view in terms of calculating that out and what the impacts may be of those changes. So that's it. We're going to get into it. So thanks for your patience, Julia, in terms of letting me get through that intro. I want to talk firstly about salary sacrificing for cars. We have a lot of questions through the business about people being told that they should look at something like a novated lease when it comes to and a salary sacrificing to save taxes, one of the claims that we hear. But can you just tell us how salary sacrificing works?
Okay, well, you salary sacrifice by saying to your employer, reduce my gross wages by this amount and provide me with a car. Now, you mentioned novated leases. So a novated lease is where really the employee has the car, has the head lease of the car, but then it's the employer takes over those payments. So then for tax purposes, the employer owns the car. But if you change employers, you just move who novates that lease for you. But it's a lease, so your employer can't get the immediate write-off on that because it's a leased vehicle. So the employer's paying for all this costs out of your after-tax dollars, and they run it professionally, supposedly. they're paying for all these costs out of your before tax dollars, and they run it professionally by calculating it out. And at the end of the year, if you don't use all that petrol, well, then they adjust it and so forth. But of course, the tax office still considers this to be part of your salary package. You've earned it. So they're going to tax it, but they tax it under the FBT regime, fringe benefits tax. And the way they arbitrarily measure the value or the tax you pay is they say, right, we take 20% of the original cost of the car. After 4 years, that's reduced by a third, but they start with 20% of the original cost of the car is what effectively gets a bit fiddlier with numbers, but basically that's how much you pay in tax. So if the car costs $50,000, every year your employer is going to have to pay $10,000 in tax, in FBT for it. Now, this assumes that the employee is on the maximum tax rate. So if you're not, make sure you make an employee contribution to bring that down to zero. By the employee contribution is your after-tax dollars. So you pay for part of the pay for getting that car. Your employer's still got all these advantages that they only have to pay tax on that 20%. They get the GST back on the fuel and the purchase of the car, or on the lease payments. So you've got to do the numbers, but hopefully there's a win there.
So there's a couple of questions I want to ask you about sort of understanding the pre-tax versus the post-tax. So the idea here is that the people who promote these opportunities to do novated lease and salary sacrificing is trying to allow the consumer, the taxpayer, to access assets or opportunities with pre-tax dollars. In other words, it's before the tax is then calculated, which ultimately reduces their taxable income. And that's the tax benefit that these promoters are talking about, isn't it?
Yes, but there's a clawback in this FBT because the employer is going to take the FBT off you too. And the tax office did the numbers to try and even it out so you don't get the benefit, really. So you make sure you do the numbers before you enter this package and see if there's any benefit. Now, if you're using that car partly for work purposes, then you can't claim a tax deduction in your return for that work use because you don't hold the car. That's the employer does. So you need to keep a logbook on that car and try and persuade your salary packager company to reduce the amount of FBT paid on saying, well, you can't charge the full amount because half of the time it's being driven for work. So what really happens is when you've got a highly used car like a salesman or something, the employer covers the whole lot and they hopefully have enough sense to get you to keep a logbook so that they don't have to pay FBT. But otherwise, they just pay the FBT rather than try and get their employees to keep a logbook for 3 months. So the bottom line here is make sure you do the numbers to make sure the package works for you. And remember, 20% of the purchase price of the car is pretty high. And that, to me, leads to electric vehicles because...
Well, it does. And I want to come to that, but I think so for me, in terms of what I see in terms of some of these, novated lease companies and so forth, is that they are claiming things like, ultimately, you get to choose the car that you want. They will negotiate better with their buying power to get you a cheaper car, is one of the claims that they make. And it may be true if they ultimately are. But I think what you're also alluding to for really high income earners, it may not necessarily be as valuable as maybe someone who's looking for just a moderate car and a standard opportunity to run that packaging up through, because their claims are that they'll obviously, again, be able to save on the negotiating on the car. They talk about that there's potential tax savings that they may be able to, and they've got examples on their websites and so forth about doing that. They help in terms of reducing the management of your budgeting. They smooth your budgeting out because all of your costs are forecast and the running costs are also calculated in there. But I think the point that you make there is that it's got to be case by case, doesn't it? Because ultimately there's going to be different nuances and different examples where there's private use versus business use of that car. And so for me, that's probably where it comes down to talking to your accountant as opposed to talking to this novated lease company who are going to make it sound attractive, and especially if there's borrowed money attached with that arrangement. What happens if you have to borrow money as part of securing the car?
Well, that's the employer has to borrow the money.
Yes.
Yep. Anyway, yeah. What I've found is that the lease companies sometimes won't even let you know how much they got the car cheaply for, and I've worked it backwards and found that it wasn't any bargain anyway. So but you make a very good point there, Ben, that if you buy a cheap car and you're only paying FBT on 20% of a really low value car, or the car's 4 years old and you've got to that 2/3, but it's got to be 4 years held by within the group.
Yep.
Then you're paying FBT on a really low value, and most of your running costs are going to be the same. The rego is going to be similar, the insurance is going to be similar, the fuel's going to be the same. So, they might, depending on the car. So the flashier the car, the more expensive the car, the less likely the package is going to work in your favour too.
Yeah, and that's sort of what my research has uncovered in terms of, from the times that I've looked at this over time, is that, the ATO saw what was happening years ago and tried to tidy up, the big European and the high luxury end cars, and now it's not as advantageous. And in fact, as you're arguing, it may not be actually financially beneficial at all, case by case. But what is interesting is in that sort of more mainstream or lower area of salary packaging and so forth, there does seem to be some tax savings that do wash out there if you can run the car economically and you can run a standard car. But again, I would be saying to everyone here is get an independent assessment through an accountant in terms of being able to assess that, because we are saying here that there are case-by-case examples in terms of when that is true. And in terms of some jobs that you mentioned fringe benefit tax there before, Julia, there are some jobs like nurses and so forth who do get some concessions around some fringe benefits and some, certainly the ability to salary sacrifice things beyond cars like mortgages and some other costs. So, what do you say to those people when they are coming to you and asking you those questions around what is possible? Is it a case-by-case basis again?
Yeah, well, I tend to, with the people working for hospitals or public benevolent institutions, say continue to package in that part of it, the exempt part, your house mortgage payments and that sort of stuff that we've got no possible deduction for, and let the car stand on its own, because that's where we're looking to try and get a tax deduction. We've got no chance with the house. And remembering, important to remember, that you're not going to get to claim for your car as a tax deduction if it's salary sacrifice. So some of these PBIs do the running around to care for people in their car. They won't get any tax deduction for all that running around in their car if they salary sacrifice it. So it's another, for that end of the market.
Yeah, for that group of people, as you say, who are going out and doing care inspections for people in home and those types of things, NDIS work in terms of moving around to see some of their patients or whatever. So again, another example of where for some people, the whole idea of novated leases and salary sacrifice may be a consideration. And remember, it's a three-way relationship there with the employee and potentially the company who may be managing it together. Or if you're going it with the employee and the employer alone, get that advice in terms of making sure that the numbers are going to stack up as part of that.
Yeah, and whether you're interested in buying a new car, because let's not make it as an excuse to get. I'm always on to clients wanting an excuse to get a new car, and what's wrong with the one you've got?
Yeah, well, I think, look, they're always going to be talking about the benefits of, you've got a warranty period, you've got less maintenance issues and those types of things. But there are also some novated lease companies who certain second-hand cars may be part of that consideration as well. So this is why we're sort of saying it's not a definite no. There are some, there's potentially some considerations where it may work for people, but it's not as a sweetheart a deal as what's basically being put on the table for everyone to think about when you are being pitched this opportunity. And it's like anything that I see from time to time in my time, Julia, around anything that's being promoted to save tax, and that's one of its biggest selling points, usually isn't worth the salt or isn't worth the effort. It's got to have another primary benefit, not just something around tax, because we also know that, with different changes of government, we can see different tax legislation change from time to time.
Yeah. Yeah, everything should stack up on its own before you then go, well, how do we get the best tax outcome from this?
Yeah. But we did see Labor, the Labor Party, come to the election recently, and this is a good segue into the electric vehicles conversation that we wanted to talk about here as part 2 of today's episode. And that is, they were talking about bringing in a policy. Can you talk to that policy promise that the federal Labor government, now obviously in power, that they were talking about in regards to electric vehicles?
Yeah, it's a bit hard to be absolutely sure because by the time people are listening to this, odds are it's through Parliament, because it's at the moment, it's there, it's in the lower house. So there will be changes, but so if I just explain the basic concept that we know will be for certain, and that is that there'll be no FBT. This whole amount that we've been talking about, this 20%, if the car is a electric car or fuel efficient car and it's under the luxury car tax limit, then there's no FBT your employer has to pay. So obviously buying the car yourself is not going to help. This is another reason to salary sacrifice. It's got to go through your employer to get this concession. No FBT. So basically the money for running that car, etc., is FBT. It's tax free to you. So that it's like tax-free dollars. And think about the amount that you save. We said 20% of every year your employer has to pay in FBT. So after 3 years, which the thing is only going to last for 3 years, at what they're stating on their website and saying that it'll only last for 3 years and then they may revert back to charging FBT. That's 60% of the purchase price you're going to save. That's got to be huge, hasn't it? Especially on electric cars.
That's absolutely material. Now, there is also another element here that we need to consider, and that is around the immediate asset write-off story in here. This is where it does make it a little bit more complex. This is the great thing about tax policy, right? It's never easy. There's always nuances and different layers in terms of what we do. And I mean, we'll get into the health insurance one in a minute, but this is a perfect example of there's carried over policy that we had from the previous government about instant asset write-off. So can you explain that to the viewers in terms of what that might mean as part of considering buying an electric vehicle as well?
Right. Now, if you're going to do it for a novated lease so that you technically hold the car and you can move it from employers, interest asset write-off doesn't apply at all because there's no asset being bought. It's a lease arrangement. But if you're looking at this from an employer's point of view where you're going to buy the electric car and start giving it out in the fleet, then interest asset write-off stops at the 30th of June 2023. And it's got to be installed ready for use. And we all know how long you've got to wait for a car these days. Yeah. So what really worries me now, that the legislation before Parliament said cars purchased after the 1st of July 2022, and they did say that on the website originally before the election. So that's pretty consistent. What I'm concerned for is the influence that as it goes through Parliament saying, well, this is a bit silly because FBT years start on the 1st of April. So they're going to say, well, this is a bit silly. We've got this fine line somewhere along the line during the financial year or during the FBT year where that car that day and that car that day is treated differently. Let's get everyone ready to go and we'll start for the 1st of April 2023. So this is my big worry, that people rush out and buy it and then got it too early. But the legislation does say 1st of July 2022 now. And it also says that if you ordered the car before 30th of June 2022, but didn't get it delivered until after that, then you still get the concession. So I'm hoping that you can my bet is you can probably order the car now, but I'm a bit worried. So you got from 1st of April to 30th of June to have it installed ready for use, to be absolutely sure you're going to get all these lovely concessions and get the immediate write-off. So good luck with that one. And
there's a cap on the number of cars that they're looking at. Is that still in play in terms of the amount of opportunities that they have with these FBT waiver?
No, I've seen no limitation in the stuff I've reviewed.
Okay, sorry, that's my bad in terms of thinking whether there was any limits. But so that's good news.
There's a cap on the price. The cap on the price you pay for it. Rightio.
So effectively, they're sort of saying unlimited number of electronic vehicles can be purchased under this arrangement. If you're looking at that as another incentive in which obviously we want to change from combustion engine, oil-driven cars into obviously a new cleaner world with electric vehicles as well. So let's see how the legislation finally lands. And as you were saying, you're thinking that at this stage there could be a wait and see opportunity here. But if you are reasonably confident that the legislation will go through unchanged, then basically having a pre-order, because my understanding is also there's a long waiting period for electric cars or any type of car at the moment, but it just does make that a little bit uncertain. So in terms of what you want to be doing around when you order your car versus when you receive the car. So is there any view to wait till the 1st of April, or have I got you right in saying that at this stage you're reasonably confident for them to be, if they're interested in this opportunity, to learn more about it and then put their purchase order in?
Well, it's a crystal ball thing, but we've got to rely reasonably strongly on the legislation. If you're going to novate lease it, then you've got no reason to rush about the June 23.
Yep.
So I'd just wait and see until it gets all the way through and then go and order. Yep. But if you're worried that you won't be able to have, because you want to write it off and you won't have it first installed ready for use, I'd be inclined to order it now. If it was me, I'd be ordering it now to make sure I've got it by that time, but making sure it's very clear you don't want it delivered until after the 1st of April, just in case. You've got every possibility covered there. But if you've got an opportunity that someone's selling you a very good car right there now, well, they're going to get screamed at if they turn around and change that date that was on the original bill. So I think you're reasonably safe to buy it now. I'm just adding a little bit of conservative, saying after the 1st of April 2023. And I could be quite wrong. I've been wrong before, Ben, but not when we were arguing earlier. I wasn't.
Never arguing, always debating about love. I love this. I love anything to do with tax and implications for all parties. So that's all good. Hey, so in terms of, so I'm really clear on that, because I'm still probably got a little bit of grey area for me for someone who's new to this legislation. What we're talking about there is two parts. There was one about novated lease, but are we also saying that there's an opportunity for a direct purchase of an electric vehicle, which the federal government is going to help subsidise?
Well, the direct purchase, you remember this immediate write-off that you were very keen about. You can't do that under novated lease. You've got to buy the car.
Yeah,
even if you borrow money to buy it, you've got to buy the car to get the immediate write-off.
But the immediate write-off is effective for businesses, not so much individuals.
Yeah, no. And if you want to technically own the car, the only way you can salary sacrifice it and sort of have some holding ownership of the car is to novate lease. So there's your catch-22.
There. So if you're going out thinking that you can buy an electric vehicle and the federal government's going to give you a subsidy or a kickback, that's not true. It would have to be through these arrangements in which you're self-employed and potentially looking at the asset write-off, or if you are through a novated lease opportunity is what the federal government's looking at there in terms of that policy. So I think that's helped me, because what I didn't want consumers to be thinking about, or viewers to be thinking about, is, all right, so the federal government has some type of kickback in regards to electric vehicles. But what we can talk about, and this is the final word on electric vehicle concessions, is a lot of states and territories do have certain incentives for businesses and for potential, in some cases, individuals, where they are looking to attract people or steer people, influence people into buying electric vehicles going forward. So what we will do is, in the show notes, we'll make sure that we put some of the links to that information as part of that. So we've got all of the different legislation from all the different state and territory arrangements. So you can see what's applicable when it comes to buying electric vehicles. I mean, it's good for the planet. Over the long term, it's probably going to be very good from running cost point of view. They will be cheaper to run over the longer term. So that's something to consider in terms of electric vehicles. So thank you for that update in regards to cars and what we're seeing in terms of novated leases and electric vehicles. Let's pivot now and talk about private health insurance. This one is always, fun for me in terms of just trying to keep up with the legislation. There is so many moving parts when it comes to health insurance per se and private health insurance and Medicare levies and so forth. So I think we need to start from the very beginning let's understand a bit about what the Medicare levy is and why it was originally introduced. Julia?
Oh, well, way back in the Medicare levy day, that was Hawke. I remember that was only just starting work. And that was so that we all didn't have to pay for going to hospital and that sort of stuff. It provided us with the health system. And I think it was about 1% back then. And then Julia Gillard increased it a bit to cover NDIS, and there were other increases online. It's now at 2%, and they still need to put more pressure on. So they, I think that, and they needed to incentivise people, if they could afford it, to have private health insurance to take pressure off the public hospital system. So they brought in the surcharge.
So it's for basic hospital, what we need to understand that. And what we're also been seeing is if less people are in the private system, there's more cost on the public system and more pressure on the public system. So what the governments then looked to do, it was to potentially give you a rebate or an adjustment if you took out private health cover. Is that the best way to describe what's happening in regards to private health insurance and its relationship with this levy?
Well, you could call it a rebate if you're a politician, but really they've introduced another tax. And they said, we'll give you this back, but we're charging you that. So, no.
I think that's important. So let's unpack that, because that is the big piece here. Like, ultimately, they're still catching all of us. But yeah, there was a trend there where people were getting out of private health cover. And so what did they try to do to get the balance right in terms of introducing these types of surcharges and etc.?
Well, also you've got to remember, from a high income earner's point of view, that they might not want private health cover because they don't need to insure against the possibility. If they have to go to hospital, they've got the money for it. So they had to incentivise for the high income earners they wanted more Medicare. But
Yep.
How are we going to do it? We can't beat up on the lower income earners anymore. So we'll introduce this surcharge. So it's two parts. There's two ways they get at the high income earner. And they start picking on them when a single person goes over 90,000 in adjusted income and a family combined income goes over 180. So once you go over that, you will cop an extra surcharge over and above the 2% Medicare levy that applies to everyone except the very low income people. You'll cop an extra surcharge unless you have private health insurance, but you don't need all these fancy expensive policies, though it's still pretty expensive. You need basic hospital, public hospital, you need basic hospital cover with an excess, if you're a single, of no more than $500, and if you're a family, no more than $1,000. That's all you need to get out of the surcharge. You need to have it the whole year. The real trap is you need to have all your dependents covered. So if you're a person that has a child that's not living with you, but they're still dependent on you, you've got to have them covered anyway. Conversely, if you are living with someone whose child comes into your home now and again, and you feed them, they're considered dependent on you for this purpose too. So they've got to be covered. So it's really, if you don't have everyone that's relevant covered, forget it. You might as well not have the coverage. So that's the first part. They say we're going to charge you an extra surcharge if you don't have private health insurance, and that surcharge goes up depending on how high your income is. Then they also introduced a discount to get more people to have private health insurance. And they said, right, we'll give you a rebate of 30% on the premiums you pay to the private health funds. But then they took it away by saying, once your income gets up this high, your discount reduces. So when we present people that have got a really high income with their tax assessment, they're seeing 2% of their income go in the normal Medicare levy. They're sort of got used to that. And then they see if they didn't have someone covered, they cop the surcharge. And then they've told the health fund for the coverage that they did have, oh, yes, give us the discount. And the tax office says you weren't entitled to that discount. Your income's too high. Give us that back too. And I like my job because it's about getting big refunds, and I feel like Santa Claus. And it doesn't go with the program.
No, this definitely doesn't go with the program. But I mean, you can understand from a government's point of view that the way in which our health system is set up here is that they need a balance of public-private. It's not fully funded public. So, and they're saying to people who are earning what they consider higher incomes that they should pay a little bit more or get into private health cover, because that's exactly where we want you to be. Like ultimately, the public system is built around a safety net and a standard system. But again, because costs are going up so high when it comes to medical, they're introducing these sort of different types of rebates. But as your income gets higher and higher, it's really clear that it's going to be, you're going to be caught in terms of having to pay extra for the medical services that this nation has. And we do have some of the best medical services. So it's one of those catch-22s. I'd much prefer to be unwell in this country than a lot of other countries around the world when it comes to that. But make no mistake, the higher the income you earn, even if you do have private health cover, you are going to be paying more and more when it comes to supporting the health system in this country. Is that a fair statement, Julia?
Yeah, and don't forget your gaps. It's almost like you go into the public hospital and you go, they say, have you got private health insurance? And I hate lying to people. I'm not, and you've really got to say, oh, no, I haven't. Otherwise, it's $500 here, $500 here, and you're getting the same service.
Well, especially in the public system as opposed to moving through. Yes, that's exactly right. But of course, you know, that's how the system's built. Now, what is interesting that, you know, some of our viewers and listeners might be thinking about is when we talk about how do we address income, it's different to say, you know, property investing, where with negative gearing, that will reduce the amount of gross income and hence the tax will be adjusted. In this particular case, there is some fine prints, aren't there, Julia, where they treat income differently for the assessment of these health charges. Let's just call them that.
Yes, that's why I used the word adjustable income when I was talking about the $90,000. So there's some things that add back. I'm just trying to, I've got them written down here. But yes, so for starters, the rental property losses are added back. So if you've made you say your income's 90,000, you know, or 89,000, got under the threshold, I'm right. And then but you had $1,000 rental loss in there, they add that back, you've gone up to 90,000. Your reportable fringe benefits already also added in. So we were talking earlier about cars. Whatever they work out the taxable value of that car goes on your PAYG summary. It does, you don't get taxed on it, but it gets in your tax return. They add that back to decide whether you're going over the 90,000. What else have I got? Oh, and if you make any salary sacrifice super contributions or contributions yourself that you claim a tax deduction for in the in your own tax return. There's other bits, but they wouldn't affect the average person. So there's a lot of add backs. So
in other words, you really, you know, you're probably thinking about your broader income is probably what's going to be assessed here when it comes to the Medicare levy and the surcharges and how they adjust for rebates and so forth. So there is a lot of complexity in that. Again, it's not about beating the system, but it's probably good to get some advice around this in terms of speaking to your accountant in terms of understanding how close you are and what those impacts can be. Because is there any way in which there might be a way to get under those thresholds that is a legitimate legal way, Julia?
No, well, that's what those add backs are about. The only thing is your work, assuming we're talking employees here, your work-related deductions there. So it might be time to go out and buy new uniforms if you're that close, or a bit of stationery, or, you know, I don't think donations are added back. Certainly not in that list I had there in front of me. No. So yeah, and I would have put it if it was there. So that could be, you know, obviously another consideration in terms of how that works. And in terms of there's obviously different scales of the rebates. We won't go through all of those scales because we'll be sitting here reading off numbers. But is there anything further that you wanted to add around the private health insurance rebate? We've done a broader view on it, but is there anything further you'd like to add? Well, it's a rebate is one word that I think most people understand it as the discount they get on their premiums when they're talking to the health fund. It's the discount.
Yes.
And the health fund, if you tell them the exact amount of income you expect to have, they will work out whether you get 30% or 26%, all those numbers you were talking about that shade, and try and hit as close as possible, so that you don't have to pay. But it's not the end of the world. I mean, you could just say, look, take it, don't give me the discount now because I'll get it when I do my tax return. Because if you haven't got any discount, you do qualify, then they'll just give it to you as an extra refund in your tax return.
And I think that's the easier admin course in terms of, again, not trying to get that up front. On balance, Julie, do you have an opinion about the benefits of private versus public? Because again, we're seeing a lot of different moving parts, and it's probably case by case for each household. But do you have a general view about the idea of taking private health insurance, or if there's any, you know, advantages that you can see when your customers are asking, you know, should I be doing this? Should I not be doing this?
Well, the surcharge is definitely designed to be high enough that it's worth having the private health insurance. So it's a no-brainer. Get out there and get it as soon as possible. At the start of the year, you're going to have higher income. Like I said before, I hate lying to people, but if I'm rushed into a public hospital, I'm not going to leave on, I've got it. It's no advantage. But the other, as most people know, I broke my ankle, and as they were racing me down, I was in agony, and they were racing me down. I'm sucking on the green stick. And I thought, the private hospital's closer. I said, I've got private health insurance. They were happy to offload me to the private hospital. Yeah,
I've recently had an eye operation, the same sort of thing. This is when it does, when you are private, if some cases it's not elective surgery, if it's not emergency surgery and it's an elective surgery, that's ultimately where you're potentially going to get your health issues addressed. So if they've designed the system where there's an advantage of having private, you've heard from the expert in terms of, go out there and get it. And as you were saying, is there an opportune or best time to start it? I did hear you mention a date earlier, but is there anything else you'd like to add to about when you should potentially start private?
Well, if you don't have it at the start of the financial year on the 1st of July, then you are going to pay some surcharge because it's prorated. So if you got it halfway through the year, you'll only pay half the surcharge you would have paid. So
prorated, so get it as soon as you possibly can for you and the family. And obviously, remembering that your health is your wealth. So it's always important that you put those health matters always first. So that wraps up our conversation around the Medicare levy and private health insurance. Is it worth it? Let's now turn our attentions to one of the biggest stories for this year in regards to tax, and it's a state-based tax we're talking about here. We wanted to talk about the changes to the Queensland government's land tax and how they go about taxing people who own investment properties inside Queensland and who own investment properties inside and outside of Queensland, because there is a change to the way in which they calculate that. Julia, can you take us through those changes, please?
Righto, let's start with the first introduction of it. So if you, in Queensland, if you have more than $600,000 worth of land value, so that's the value in your rates notice, it's the unimproved value. If you have more than 600,000, you start to get, per individual, you start to get caught in the land tax area. Now, your own home is exempt from that, so it's only properties that you own other than that. It's not just investment properties, it's holiday homes too. Now, if they're owned in other entities, there's a different threshold. It's 350,000 for companies, trusts and super funds. But let's just concentrate from the individual point of view. We used to think it was very clever to buy properties. Once you got close to the land tax threshold, you move on to another state because it's a state tax. So every state had their own threshold and you'd stay under the threshold. Well, Queensland's done it first, and I'm betting the other states might follow suit if they get away with it. But they're saying that they're going to, when they look at that 600,000, take into account the value of all the properties you own Australia-wide other than your main home. So you can imagine for the people in New South Wales, because up in Queensland, it's pretty hard to have one property with more than 600,000 land value. But down in New South Wales, and Victoria for that matter, it's not going to be hard. So suddenly, people that had just one property in New South Wales and one property in Queensland are going to be caught with land tax. The 600,000 threshold is going to be used up on their New South Wales property, and then they're in there for the whole of their Queensland property, and it's going to cop tax. And they could, the 30th of June 2023 this year, end up getting a little letter from the land tax office saying, we want about $4,000 off you or something like that. Because also, if that property land value is worth 800,000 in New South Wales, well, they're not going to tax that as such. They're going to say, well, hang on, that extra 200,000, actually, I think the next threshold's million higher. But anyway, they're going to say, let's look at, not only are you now in the land tax pool, but you've gone up into a higher land tax rate because you've got that property down there. So it's going to be huge. And we do have a fact sheet on this with the numbers.
Yeah, look, it's obviously something that I've been quite vocal on in regards to those changes, because the challenge is it's not grandfathered, and the people who say might have an investment property in Tasmania, where land values might have been cheaper than people who have a property in New South Wales where the land value is higher, there is a clear discrimination against them in terms of the way in which Queensland is going to treat how they tax that Queensland property. So we've obviously in our business been studying all the different nuances that we have for the different types of clients we have. And so we have an example might be we have one client with one property in New South Wales with a high land value, and then the one investment property in Queensland. And that person might consider selling that property in Queensland and then start to diversify their portfolio. So, I'm not so sure that everyone invested everywhere else because to avoid land tax. I think diversification as part of their investment strategy is also a very sensible component to why you would invest. So I think that's where it does come down to case by case, because what's not changing for those people who live in Queensland and have all their investment properties in Queensland, it is the status quo. There is no changes to them depending on the ownership structure. That there's business as usual. Where it does get interesting, Julia, and I'm interested in what your thoughts are here. But if you had, say, two properties in Victoria and you were looking for that diversification model, would you consider Queensland as a future investment opportunity?
Well, you'll have to factor that land tax in, but probably those people with multiple properties in Queensland are paying that land tax already too. Yeah, so it's just a matter of the numbers games. But you're talking about now, looking at the future. What am I going to buy in the future? It's only the people that have already got properties that are going to get caught out. Buying in the future, there are a few strategies you can do, because remember, land values are rather low in Queensland anyway. So not long ago, well, it might have been 6 months ago now, because we've been aware of this for a while. It's just the public won't see it until June 23. Yep. Yeah, clients of yours consulted me on, they wanted to buy several properties, and one of them was in Queensland. And we wanted a self-managed super fund anyway for other reasons. And we decided that the property we bought in Queensland was the one that was going to be in the self-managed super fund, simply because that got the 350,000 threshold. That's a pretty hard threshold to go over with one property in Queensland. So they went nice and safely. So that with proper advice, and people will have an understanding going forward now, it's going to be minimised, the impact for people buying properties. But I have got some numbers in the fact sheet that you'll get, and certainly sometimes it's not worth the cost. Super funds are expensive to run, so you wouldn't necessarily do a super fund, but you might decide to put in a trust. One of the figures, the examples I do, it wasn't worth it. It was only going to save because the property was more than 350,000. So yes, the minute you go over the 350,000, a whack of land tax hits in. So if the property was under 350,000, it was worth buying it in a trust. This is the unimproved land value. But if it was over 350,000, because that immediate amount of land tax whacks in, they're only saving $250, which didn't cover the cost of running the trust. So
no, the administrative and holding costs and the ongoing cost of that. And that's, I mean, what we do know is Queensland's decision is definitely different than the way in which other states and territories have gone about ensuring that the land value of the properties that are held in their states are taxed appropriately. So we've seen Victoria, I think, lead the charge where they started to aggregate properties that were held in trust, where the trust ownership and the beneficiaries were aligned. And that sort of made sense. You know, so that they had a obviously back in the time, there was a lot of hoo-ha about that in terms of getting that change through, because it meant that those people who did have those structures had another lump sum expense that they weren't anticipating. New South Wales and South Australia have also got complex structures. And when you start getting into different types of entities and how they work, it's just a bit of a minefield when you're looking at the land tax regimes of each state and territory. So that's absolutely true. And I think one of the things that when you're thinking about an investment in property, you should be thinking 20, 30 years and beyond. That's the way in which, you know, we look at property for the long term. A couple of sensible investment properties over the long term is what we've always advocated for, and not building out huge portfolios for the sake of huge portfolios. But one of the things that I suspect we will see is that they will continue to keep tinkering with legislation. So right now, if you did buy in a trust in Queensland, I suspect that they will look at what's happened in other states and territories as well. And I suspect that they will attempt, whether it be now or in the next decade or two, to aggregate those structures. So, you know, it's about understanding those rules. And as you're about to point out, Julia, there are ways in which you might be able to navigate around them. But if you don't know what the legislation is today, and you make your decisions today, and then they retrospectively change that legislation, that's where it's hard. But you do say, let's talk about how you may get around those legislations in terms of the trustee and also the beneficial owner, if we can talk to that.
We already have aggregation rules in Queensland, so let's hope they don't change it. But unfortunately, yeah, that does affect retrospectively. Yep. So the aggregation rules for trusts is if you've got the same trustee with the same beneficiaries, then they're considered one. But if you've got a trustee here, say you and I shared a company and we had separate trusts for our families, then that trustee would be assessed with two separate land tax notices, because it's got two separate trusts underneath it.
Yes.
But if both those trusts were my trusts with my family members as beneficiaries, then there would be one land tax assessment, which means one threshold. So it's a matter of what I'd have to do then, if it was both family members, I'd have to have a different company for each trust. If I had a different trustee, then they get separate assessment notices. So that's all I have to do, but I have the cost of running an extra company.
Yeah, so it's setting up the company, then it's the annual compliance costs of maintaining that company through ASIC, and then there's also the tax and financials and tax returns that need to be done for that company. So it starts to add up in terms of how that plays out.
Well, you don't need to do a tax return for a trustee company if that's all it does.
Yeah, good point. So yeah, it's quite interesting. it ultimately means that the government's, or the Queensland government, is trying to raise additional taxes through this change. And with that, obviously, comes higher costs associated with running and investing in property in Queensland. So it is, I think, to your point, Julia, it's one of those really interesting ones where, as you now look at your strategy, and if you already have existing properties, then you've got to take into consideration those existing properties about how you execute into the future. If you now that you know that you know this rule is coming in, it may just, if you don't already own property in Queensland, it may be beneficial for you to keep away from Queensland, or to look at a different structure in terms of what you're doing to invest in Queensland. For keeping it simple, you will probably look into state. If you want to bring some complexity and structures in, that might get you into that market. But if you already own property in Queensland and you also have property outside of Queensland, the message here is really clear. You're going to need to talk to your tax accountant about the potential impact and just how much additional costs are going to be charged. And it's very clear that it looks quite a sizable amount. In all the models that we've done on this, the percentages are usually over 300% increase in terms of the land tax that will be charged in Queensland, based on, and this is a really important point, based on owning that property as at 30 June of 2023. So at the time of recording this, in sort of late August, early September period of 2022, we are saying that having those discussions with your property investment advisor or your tax accountant is going to be important for you if you already have exposure in Queensland and you're looking to add to your portfolio, especially if you also have other properties in other jurisdictions that isn't your principal place of residence. So Julia, any final words in regards to your views on this tax grab?
No, we resolved not to have views on this. We've got opposing views, but I do want to say that it's funny. You've got to actually, you're compelled to go online and inform the Queensland government of what properties you own in other states. And I wonder why they did that, because you'd think they'd have ways and means of getting the information, but maybe they can't. But anyway, there's a deadline that you'll get a land tax assessment, that's for sure. And within 30 days of getting that, you have to go online and confess all your properties. Or by the 31st of October 2023, you have to have gone online and told them all your properties Australia-wide.
And so that's a declaration that they're asking of you to do. Obviously, there will be teething issues with the new piece of legislation coming in. My intelligence tells me that they have to employ another 9 public servants to manage this program, as well as my intelligence connections are telling me that they're asking other states and territories for their people to help them try and work out how to run this scheme. So it's and ultimately, one of the great things we also need to make mention of here, Julia, is the federal government is going to miss out also on federal government taxes, because land tax is tax deductible. So unfortunately, it's going to be a bit of robbing Peter to pay Paul, where more money is going into Queensland and less to the federal governments for their work that they do in terms of supporting the Australian society. So it really is fascinating in terms of where this is going to land. And of course, there's going to be strong lobbying from the industry, and also I suspect from property investors in general around this legislation, because it's unprecedented in terms of what they're attempting here. So it will be interesting to see basically what happened. And I can use a recent example in Victoria where the Victorian Labor government proposed a 6% developers tax. And it's an election year here in Victoria. And within 12 days of announcing that new tax, it was repealed because the industry was going to do a media campaign that says property prices under the Andrews Labor government are going to be more expensive thanks to this new tax, because they were going to pass it on ultimately to the consumer. And that is going to be the big challenge here in terms of with a cost like this and other, sort of changes that we've got new legislation in Queensland around property management and minimum standards, as well as a current rental crisis. Property rents are going to be challenged as part of that, and also higher interest rates. So it is going to be a challenging time for tenants in being able to secure property. And I suspect in terms of higher rents that are going to be paid, when you combine all of those elements together, plus increased immigration, you're going to see, property rents probably increasing over the next couple of years.
Let's hope they use the money raised to build public housing.
Well, they need to do something because, ultimately we would hate to see them waste it. The irony here for me has always been that, by implementing such policy, the unintended consequences are that they find that they change the dynamic of an open market, and then ultimately it ends up costing all of us more in higher taxes because they have to do more work to rectify and balance out the market. So that's always something that we'll have to wait and see how that plays out. Julia, thank you so much for your time once again. Your insights and your tax skills are unquestioned here. We love doing these episodes with you. That finishes out episode number 3. In terms of episode number 4, we've probably got a bit of a sneak peek. We're probably going to look more at structures in terms of the types of vehicles in which you can buy investment properties. So we might be talking about buying in an individual name, buying in a company name, buying in a self-managed super fund. I think we can unpack that story in our next episode. And if I'm forward forecasting that, we're probably looking at around sort of October, November in coming back for that conversation to do episode 4 of Talking Property Tax with Julia Hartman. So thank you again for your time, Julia. As always, it's always great chatting with you, both on air and off air. We have a great debate around obviously all of these implementations and so forth. So thank you very much for your time, and thank you for sharing your knowledge with our audience.
Oh, thank you for having me on, Ben. I always enjoy a good chat.
Cheers. All right. Until next time, remember everyone, knowledge is empowering, but only if you act on it, and take away all this great knowledge from Julia and hopefully go and talk to your tax accountant. It's really important that you understand all the moving parts, whether it be claiming personal claims, car travel claims, health insurances, all of those pieces all make up how your accountant can add value to the conversation, in addition to the property investment advice that they may give around the impacts from a tax point of view in terms of the structures that you use. So please feel free to reach out to your own trusted accountant. If you're looking to work with a new tax accountant who specialises in residential investment property, feel free to also reach out to the team at Empower Wealth and talk to one of our personal tax accountants in that area. But thanks again, everyone. Until the next episode, take care and bye for now.